Okay, let's unpack this. Today, we're diving deep into the recent financial results from a company you likely know well, the J.M. Smucker Company, ticker symbol SJM.
That's right. And we've got quite a bit to go through here. The official SEC filing, that's the 8K with their press release, it covers Q4 and the full fiscal year 2025.
Right, which just wrapped up for them.
Exactly. And we also have an analysis piece, gives us a bit of outside perspective, how the market took the news.
And our mission today. Cut through all that financial jargon, the numbers, the spin, pull out what really matters for you. What's the story here? What happened last quarter, the full year?
And crucially, what are they forecasting for fiscal 26? What does it signal about Smucker's, but also, about consumer spending overall?
Because the first thing that jumps out from the sources, it's a bit of a mixed picture, isn't it?
Yeah, definitely. For the quarter, they actually beat the adjusted earnings per share forecasts, so better profit than expected on that measure.
Which sounds good, but...
But they missed on revenue expectations.
And the market reaction. The analysis piece mentioned that.
Not great initially. Saw a pretty noticeable pre-market dip in the stock, over 7%, reacting to the results.
Okay, so there's the tension right there. Better adjusted profit than expected, but a revenue miss and a pretty negative market reaction. Let's jump in and figure out what's driving these numbers. We're talking Uncrustables, Cafe Bustelo, Jif, Hostess, Milkbone, lots of familiar names.
Absolutely. So let's start with those headline numbers for the fourth quarter. Fiscal year 2025 ended April 30th. Net sales landed at $2.1 billion.
Okay, $2.1 billion. And how does that compare?
Well, two things stand out. First, it's a 3% decrease compared to the same quarter last year. Second, it missed the analyst forecasts. They were expecting around $2.18 billion.
So about $80 million short of expectations. That revenue miss seems key.
It is. Now, profitability. This is where it gets really interesting and maybe a bit confusing at first look.
How so?
Well, if you look at the standard accounting, the GAAP net income, it shows a pretty significant loss.
A lot?
Yeah, a loss of $6.85 per diluted share for the quarter. Compare that to the gain of $2.30 in the same quarter last year. It's a huge swing.
Wow, okay. A nearly $7 loss per share versus a $2 plus gain. That sounds dramatic. But you mentioned adjusted earnings per share earlier. Why the focus there, and what did that look like?
That's a great point. So adjusted EPS, it's a non-GAAP number companies use, analysts use it too, to try and get a sense of the ongoing core business performance. They strip out items considered, one-off or non-operational.
Yeah, smoothing out the noise.
Exactly. And in this case, Smucker's adjusted EPS for the quarter was $2.31.
Okay, $2.31. And how did that compare to forecasts?
And here's the twist. It actually beat the forecast. Analysts were looking for $2.24. So a positive surprise of 7 cents per share.
Huh. So even though it was down year over year, you said $2.66 last year.
Down 13% from $2.66 last year, correct? But still, it beat this quarter's expectations.
So let's recap. Revenue down, missed forecast, massive gap loss. But adjusted EPS, while lower than last year, was better than expected. How do we square that huge gap loss with the adjusted profit beat? What explains that difference?
The source points right to it. That enormous gap loss, it's almost entirely down to these significant non-cash impairment charges, totaling $980 million.
Whoa, nearly $1 billion. Non-cash, you said. What does that actually mean? It's not cash leaving the company.
No, that's the key. It's an accounting adjustment. It happens when a company decides an asset on its books isn't worth what it's currently valued at.
Okay.
In Smucker's case, this $980 million, about $867 million was related to the goodwill from the sweet baked snacks business.
The Hostess acquisition.
Right. And another $113 million or so for the Hostess brand trademark itself.
And the source connects this directly to the performance of that Hostess business.
Yes. It explicitly says the sweet baked snack segment hasn't met expectations since they bought it. So this charge is basically Smucker saying, okay, based on performance so far, the value we put on this business needs to be written down on paper. It hits the GAAP results hard, but doesn't affect their cash flow for the quarter.
But it definitely tells a story about how that acquisition is panning out so far.
Absolutely. It's a big flag for that segment.
Okay, that clarifies the gap loss situations. Let's go back to the revenue miss. Sales down 3% overall. But what about comparable sales, stripping out acquisitions and divestitures?
Good question. On a comparable basis, sales were down just 1% for the quarter, so slightly better than the headline number suggests for the core ongoing business.
And the source breaks down that 1% comparable decline. What drove it?
It does. The biggest factor was volume and mix. Basically, they sold less stuff or a less profitable mix. That decreased sales by 3 percentage points.
Which products specifically?
Well, the source calls out declines in dog snacks, those sweet baked goods again, lower sales from contract manufacturing for pet food brands they sold off that's ending now, and also fruit spreads.
Okay, so weakness there. But were there bright spots offsetting that?
Yes, definitely. Uncrustables growth helped offset some of that volume mix decline. And then there's pricing.
Price increases.
Right. Higher net price realization increased sales by 3 percentage points, mostly from coffee price hikes, although some of that was offset by lower pricing in, guess where, sweet baked goods and dog snacks. Maybe competitive pressure there.
So pricing helped the top line, particularly coffee, but lower volumes in several areas, including those getting price cuts, weighed it down. How did all this flow through to adjusted operating income?
Adjusted operating income was down 8% for the quarter. The source says this was mainly because adjusted gross profit fell 9%.
And why was gross profit down?
Driven by higher costs, that unfavorable volume mix we just talked about, and the impact of businesses they sold.
Yeah.
The higher prices only partially offset these things.
Anything else helping the operating income line?
Yeah, they did manage to lower their selling, distribution, and administrative expenses, SD&A.
Okay, SD&A. What's in that?
Think overhead. Running the business, selling the products. The source mentions lower admin costs, less marketing spend in the quarter, and lower pre-production costs for that new Uncrustables plant now that it's up and running.
So some cost control there helped cushion the blow to adjusted profit.
Exactly. That helped them deliver that adjusted EPS beat despite the top line and gross profit pressures.
Got it. So Q4, volume pressure, cost challenges, especially in specific segments, but some pricing power in coffee and cost control helping the adjusted bottom line. Let's zoom out now. The full fiscal year 2025, what's the bigger picture?
Okay, full year. Net sales landed at $8.7 billion. That's actually a 7% increase compared to fiscal 24.
But wait, wasn't Q4 down? How does that work?
Good catch. That 7% growth includes the big impact of the Hostess acquisition. If you strip out acquisitions and divestitures, comparable net sales for the full year were actually flat. Zero growth year-over-year.
Okay, flat comparable sales for the year. And that huge Q4 impairment charge. How did that impact the full-year GAAP result?
Hit it hard, as you'd expect. The full-year GAAP result was a net loss per share of $11.57. Compare that to a gain of $7.13 in fiscal 24. Again, heavily driven by those Q4 non-cash charges.
But just like the quarter, the adjusted full-year number tells a different story.
A slightly different story, yes. Full-year adjusted earnings per share came in at $10.12. That's actually a modest 2% increase from $9.94 the prior year.
So while Q4 adjusted EPS was down, for the full year, they managed slight growth on that adjusted basis. That's important.
It is. Shows some resilience over the full 12 months, despite the tough final quarter.
What about cash flow? That wasn't hit by the non-cash charges, right?
Right. Free cash flow was strong. $816.6 million for the full year. That's a big jump, up $174 million from the prior year.
And capital spending.
They invested $393.8 million in capital expenditures. That's about 4.5% of their net sales. The source notes they're making progress toward a long-term goal of getting that down closer to 3.5% of sales.
And dividends. Important for many investors in a company like Smucker's.
They kept that going strong, returned over $455 million to shareholders via dividends, $4.32 per share for the year. And the source makes a point of highlighting, this is their 23rd straight year of dividend growth.
That's a long streak. Okay, how's the balance sheet looking after buying Hostess? Debt levels.
They ended the year with $7.6 billion in total net debt. Their leverage ratio, based on adjusted EBITDA, is sitting at 3.6 times.
Is that high? What's the plan?
Well, they stated their financial priority is debt reduction. They aim to pay down about $500 million a year for the next 2 years. The target is to get that leverage ratio down to 3.08 times or lower by the end of fiscal 27.
Okay, clear focus there. So, big picture summary. Flat comparable sales for the year, slight adjusted EPS growth, strong cash flow, consistent dividend growth, and a plan to tackle the debt. Now, let's dive into the segments for Q4. This is where rubber meets the road, right? Seeing which brands are pulling weight and which aren't.
Exactly. Let's start with U.S. retail coffee. This was a highlight in Q4. Sales up a strong 11%.
Wow, 11%. What drove that?
Almost all pricing. The source says a 10 percentage point increase came from net price realization. Folgers and Cafe Bustelo specifically. Volume and mix were basically flat. Cafe Bustelo growth offset some Folgers decline.
So coffee growth was all about charging more. How did that impact profit? especially given what we hear about coffee bean costs.
Ah, that's the catch. Despite that strong top-line growth from pricing, segment profit was actually flat. Didn't grow at all.
Why not?
The source blames record high green coffee costs. So the price hikes boosted sales, but soaring input costs just ate up all that benefit on the profit line. They mentioned taking more price hikes in May and planning another in August to try and catch up.
Fascinating. Shows that commodity pressure is real. Okay, next segment. U.S. retail frozen handheld and spreads. This includes Uncrustables, Jif.
Right. Sales here were flat for the quarter. Zero growth. Price actually decreased sales by 1 percentage point overall. They mentioned lower pricing on Jif and Uncrustables in the quarter, though Smucker's toppings saw an increase.
The price was a slight negative. What about volume?
Volume and mix actually increased sales by 1 percentage point. And the source says this was driven by Uncrustables growth, which managed to offset declines in fruit spreads.
So Uncrustables volume growth was the hero in that segment, offsetting other softness and that slight price dip. How did the segment profit look?
Profit was down 5%, impacted by a few things. Some equipment write-offs mentioned, higher costs generally, and that lower net price realization we just talked about, partially offset by lower costs from the new Uncrustables plant coming online and less marketing spend.
And they mentioned taking a price increase on Uncrustables recently.
Yes, in early June, just after the quarter ended, so we might see that benefit flow through in Q1 of fiscal 26.
Okay. Moving on to U.S. retail pet foods. How did that segment fare in Q4?
This one saw a pretty significant decline. Sales down 13%.
13%? Ouch, what happened?
Mostly volume and mix again, down 11 percentage points. The source points to lower dog snack sales and the end of that contract manufacturing business, which had about a $16 million impact. Price was also down 2 points, hitting dog snacks and cat food.
And profit.
Segment profit fell 7%. The source mentions retailer inventory adjustments hurting them, plus a slowdown in discretionary spending hitting things like dog treats, people cutting back.
Any silver linings in pet foods?
Well, looking at the full year, the segment actually expanded its profit margin significantly by over 500 basis points. And Meow Mix cat food saw retail dollar sales increase 3% in the latest period. So some underlying strength there, particularly in cat food, despite the tough Q4 for the segment overall.
Okay, now for the segment that seems to be causing the most headaches and those big charges. Sweet baked snacks. The Hostess brands.
Yeah, this is the big one. Sales just plummeted, down 26% in Q4.
26%.
Yeah. And even if you exclude divestitures, comparable sales were still down a very sharp 14%.
What drove such a steep decline?
It was broad. Volume and mix were down 9 percentage points across snack cakes, donuts, even private label stuff. And price was also down 4 percentage points. Suggests they might be discounting or facing unfavorable mix shifts.
And the profit impact must have been severe.
Yeah. Brutal is probably the word. Segment profit fell off a cliff, down 72%.
72% decline in profit. Wow. Why such underperformance?
The source points to two main things. One, consumers pulling back on discretionary items like snacks due to inflation. Two, execution issues. Problems with distribution and merchandising since Smucker's took over.
So a tough category environment compounded by integration challenges. This explains those huge impairment charges.
Exactly. The company even updated its long-term growth expectation for the segment down to just 3%. A big reset.
Are they doing anything to fix it? What's the plan?
They laid out a revised strategy. Focuses on strengthening the portfolio, improving execution, trying to reignite growth. Specific actions mentioned include optimizing the product assortment, being smarter about pricing, potentially closing their Indianapolis facility to consolidate manufacturing, and creating a dedicated sales team just for this segment.
Sounds like they're taking it seriously. Okay, last segment. International and away from home.
This one was actually a grower. Sales up 3% in Q4, or 4% if you exclude currency effects.
What drove the growth here?
Similar story to coffee in the U.S. pricing. Net price realization added 6 percentage points, mainly from coffee internationally. Volume and mix were down slightly, by 1 point, hitting coffee and portion control items. But guess what grew here too?
Let me guess. Uncrustables.
You got it. Uncrustables saw growth here as well, and segment profit was up a solid 13%, helped by the higher prices and lower startup costs from the Uncrustables plant. The away-from-home part specifically saw 5% comparable growth, led by Uncrustables volume.
Uncrustables really is the star performer, isn't it? It's popping up everywhere.
Absolutely. The company specifically called out its key growth platforms, the brand's expected to drive over 80% of growth in the next 5 years. Uncrustables is right at the top.
How big did Uncrustables get in fiscal 25?
Another year of double-digit growth, reached over $920 million in sales for the full year.
Almost $1 billion.
And the CEO said they're on track to hit over $1 billion in net sales by the end of this fiscal year, FY26.
Incredible for a frozen sandwich. What's the fuel behind that billion-dollar target?
Combination of things listed in the source: more advertising, wider distribution, rolling out new varieties, including limited editions, and crucially, that new production capacity coming online from the Alabama plant. They need to make more to sell more.
Makes sense. And Cafe Bustelo was another one of those key growth platforms.
Yes, absolutely. Still one of the fastest growing coffee brands out there, gaining share. Within Smucker's U.S. retail coffee business, Bustelo grew 19% in FY25, hitting over $400 million in sales.
And they expect more growth there.
Yep. They anticipate another year of double-digit net sales growth for Cafe Bustelo in FY26. They also highlighted the Milk-Bone peanut buttery bites made with Jif apparently outpacing competitor innovations in 2024, leveraging those connections.
Okay, so a clear strategy. Lean hard into the winners like Uncrustables and Cafe Bustelo, invest behind them while trying to fix the problem areas like sweet baked snacks. Let's turn to the future now, the outlook for fiscal year 2026. What are they guiding investors to expect?
Okay, FY26 guidance. For the top line, total net sales expected to increase between 2.0% and 4.0%.
But that includes impacts from divestitures.
Right, it does. The source notes headwinds of about $135 million from sold businesses and another $38 million from exiting that pet food contract manufacturing.
So, stripping that out, what's the comparable sales growth outlook? The organic growth?
On a comparable basis, they expect net sales to increase roughly 3.5% to 5.5%. So decent underlying growth expected.
Growth expected across the board.
Mostly. Growth anticipated in most segments except sweet baked snacks. There, they expect comparable sales to decline low single digits as they work on that stabilization plan.
Okay, so 3.5% to 5.5% comparable growth overall. What's driving that? More volume or more price?
The source says it reflects higher net prices across the portfolio, especially coffee and Uncrustables, where they've taken recent increases. But, and this is key, they anticipate an unfavorable volume and mix trend overall.
So overall sales dollars up because prices are higher, but the actual amount of stuff they sell is expected to go down?
That seems to be the implication. The source attributes that expected volume decline mainly to coffee price elasticity, basically. They assume higher prices will lead some people to buy less coffee, and those ongoing headwinds in the sweet baked snack segment dragging down overall volume.
Okay, higher prices, but potentially lower volumes. How does that translate into the adjusted earnings per share forecast for FY26? This sounds like it could pressure profits.
It does, and the guidance reflects that. This is where the outlook gets quite cautious for FY26. Adjusted EPS is projected in a range of $8.50 to $9.50.
That seems like a wide range and potentially down from the $10.12 they just reported for FY25. Did they explain the pressures?
Yes, they actually quantified several significant headwinds they expect to face in FY26, which explains the range and the potential decline.
Okay, let's hear those numbers. Quantified impacts are helpful.
They laid them out pretty clearly. First, an estimated $0.80 per share negative impact just from those coffee price elasticity assumptions, the profit hit from lower coffee volume.
80 cents just from coffee elasticity. Wow. What else?
Second, a $1.30 impact from increased marketing investments. They're deliberately spending more, especially on Cafe Bustelo and Uncrustables, to drive future growth.
So investing now, hitting profit this year, makes sense. Keep going.
Third, a $1.25 impact from tariffs. They specifically mentioned this affecting green coffee imports.
Tariffs adding another quarter per share headwind.
And fourth, a $1.20 impact from the expected decline in profitability from the sweet baked snacks segment, just the ongoing business struggle there.
Okay, if you add those up, $80.80 plus $30.25 plus $30.25 plus $0.20, that's $2.55 in specific headwinds they've called out. Are there any tailwinds expected to offset some of that?
There are some tailwinds mentioned, yes. Things like momentum in other parts of the business, cost savings from their transformation programs, getting $100 million in synergy savings from Hostess by year-end, managing leftover overhead costs, and the benefit of paying down debt.
But the guidance suggests those headwinds outweigh the tailwinds for FY26.
Exactly. The source explicitly says these headwinds are expected to more than offset the tailwinds in fiscal 26, leading to that lower adjusted EPS range.
Okay, so FY26 looks like a year of absorbing significant costs and investing for the future. How does this affect their expected profit margins?
They're guiding for adjusted gross profit margin between 35.5% and 36.0%. And they specifically called out the tariff impact again here, estimated to hit gross margin by about 50 basis points, 0.5%, mainly in U.S. retail coffee.
Because they import so much coffee.
Right. Brazil and Vietnam were mentioned as key sources subject to tariffs. They said they're working on ways to mitigate it, but it's a clear pressure point.
And that marketing increase, the $1.30 headwind that shows up in SD&A.
Yes. They expect SD&A expenses to rise about 3%, largely driven by that increased marketing spend on the key growth brands. Total marketing is expected to be around 5.7% of sales, up about $40 million year over year. It's a deliberate choice.
What about cash flow and capital spending in FY26?
Free cash flow project around $875 million, so slightly up from FY25, and capital expenditures are planned to come down to $325 million, getting closer to that long-term target percentage of sales.
Did they give any specific guidance for the first quarter of FY26, the one we're in right now? Sometimes the cadence through the year matters.
They did give some Q1 color. Expect total net sales to decline low single digits, including divestiture impacts. Comparable sales expected to be flat, so price up, volume down, continuing the recent trend.
And earnings in Q1.
This is important. Adjusted EPS is expected to decline significantly in Q1, down around 25% compared to Q1 last year.
25% drop in Q1. Why so steep?
Primarily due to lower gross profit expected in coffee because of those high costs hitting, and also in sweet baked snacks. However, they did emphasize they expect sequential improvement throughout the fiscal year. So Q1 should be the toughest quarter for profit comparison.
Okay, so a rough start expected, but improving as the year goes on. Are they looking beyond this challenging FY26?
They definitely are. Despite all these headwinds they've quantified for FY26, the company expressed confidence about fiscal year 2027. They called it an anticipated algorithm year for adjusted EPS growth.
Algorithm year, what does that mean?
It generally means returning to their expected, more typical long-term growth rate or formula. So they see FY26 as a dip, absorbing pressures and investing, with a plan to get back to stronger growth in FY27. Assuming no major curveballs, right? No huge shifts in the coffee market, consumer behavior regulations, or trade policy. Standard caveats.
Okay, and that Investing Pro analysis piece we looked at, it confirms the Q4 EPS beat, the revenue miss, and that stock drop. What else did it add?
It rated Smucker's overall financial health as fair, but noted strong growth metrics within that. Interestingly, despite the stock drop, the analysis suggested the stock might be undervalued, pointing to analyst price targets ranging from $104 up to $135.
So potential value there, according to that analysis.
Possibly. It also really highlighted that strong dividend history, 55 consecutive years of payments mentioned there, and the current yield of around 3.86% as being attractive for income investors.
So putting it all together from the sources, what are the biggest risks and challenges Smucker's is facing as they head into fiscal 26?
Well, there are quite a few overlapping themes. First, investor confidence, given the Q4 revenue miss and the guided EPS decline for FY26. Second, that continued slowdown in discretionary spending hitting segments like pet snacks and sweet baked goods. Third, the big unknown of price elasticity. Will consumers really cut back on coffee volume as much as expected? Fourth, just broader macroeconomic pressures on consumers. Fifth, navigating those record high coffee costs. And sixth, managing the impact of tariffs.
That's a lot of juggle. It really paints a picture of a company with some definite strengths, those key brands, but operating in a very complex, pressured environment right now.
For sure. Multiple balls in the air, internal execution on turnarounds and investments, plus navigating all those external market forces.
Okay, so that's our deep dive into Smucker's latest results and their look ahead. What we've really unpacked here is a company in a dynamic spot. They're grappling with some serious headwinds. High coffee costs are a big one, shifting consumer habits hitting certain categories hard, like pet treats and Hostess snacks. Plus, they're still digesting major acquisitions and divestitures.
Yeah, but on the other hand, they did beat adjusted earnings estimates in Q4, managed slight adjusted EPS growth for the full year, generated strong cash flow. That shows some solid execution on cost control and leveraging the brands that are working well. But you can't ignore the Q4 revenue miss or those huge impairment charges on the Hostess business. Those are clear signals of pressure points needing major attention.
And the strategy seems clear, right? Double down on the winners. Uncrustables and Cafe Bustelo really stand out. Impressive performance, ambitious goals, and getting significant investment. At the same time, they're taking pretty decisive steps to fix the underperformers, like sweet baked snacks, even if it causes some short-term pain reflected in that FY26 guidance.
Absolutely. It's this complex balancing act. Nurture your strengths, aggressively tackle your weaknesses, invest for the longer term, all while navigating these external storms like commodity inflation and potential tariffs. Those quantified headwinds for fiscal 26 really lay bare the challenges ahead in the next 12 months.
So here's something to think about as we wrap up, based on everything we've discussed. Smucker's is setting expectations for fiscal 26 as this year of absorbing costs and investing, aiming for a return to stronger algorithm growth in fiscal 27. They gave us pretty specific numbers for the headwinds they expect in FY26. There's 0.80 cents from coffee elasticity, 0.30 cents from marketing, 0.25 from tariffs, 0.20 cents from sweet baked snacks. So the question for you listening is, which one of those specific headwinds do you think is the absolute most critical for smokers to manage successfully if they want to actually hit that FY27 growth rebound? And maybe more importantly, which of those factors do you think is the most unpredictable, the biggest wild card for them?